This LOS is classify, calculate, and interpret activity, liquidity, solvency, profitability, and valuation ratios. Ratios. There are many relationships between financial accounts and between expected relationships from one point in time to another. Ratios are a useful way of expressing these relationships. Ratios express one quantity in relation to another. So it's one number divided by another. That's what a ratio is. There's always a numerator and a denominator. Research has found that financial statement ratios are effective in selecting investments and in predicting financial distress. Practitioners routinely use ratios to derive and communicate the value of companies and securities. Several aspects of ratio analysis are important to understand. First, the computed ratio is not the answer. The ratio is an indicator of some aspect of a company's performance, telling what happened but not why it happened. A second important aspect of ratio analysis is that differences in accounting policies across companies and across time can distort ratios, and a meaningful comparison may therefore involve adjustments to the financial data. Third, not all ratios are necessarily relevant to a particular analysis. The ability to select a relevant ratio or ratios to answer the research question is an analytical skill. And finally, as with financial analysis in general, ratio analysis does not stop with computation. Interpretation of the result is essential. In practice, differences in ratios across time and across companies can be subtle, and interpretation is situation specific. Common ratios used in financial analysis. So we can see here that there's 5 categories: activity ratios, liquidity ratios, solvency ratios, profitability ratios, and valuation ratios. So if we look first at the activity ratios, they're giving us some information with regards to the efficiency of day-to-day task operations. So we can look at turnover ratios such as inventory turnover, receivables turnover, payables turnover, fixed asset turnover. Once you have a turnover ratio, 365 divided by the turnover, we'll put the ratio in terms of the number of days. And we can also look at working capital, which is just current assets minus current liabilities. Liquidity ratios look at the ability to meet short-term liabilities. So we've got the current ratio, the quick ratio, and the cash ratio. And the current ratio, for example, is current assets divided by current liabilities. Okay? So for example, if the industry standard was 3-to-1, I'd have $3 or euros of current assets for every dollar or euro of liability that I had in terms of current liabilities. Solvency ratios measure the ability to meet long-term obligations, and the ratios there, we look at total debt, debt to capital, debt to equity, financial leverage, and then we have some coverage ratios that are falling under the solvency here: interest coverage and fixed charge coverage. Now this list is not exhaustive, as we see in different other LOS and readings with regards to debt. We look at sometimes the list of ratios is expanded, but this is a good general list. In terms of profitability, that's the ability to generate profitable sales from an asset base. So we look at gross profitability, sales minus cost of goods sold, gross profit. Operating profitability, same thing. We're putting things as a percentage of sales, okay, to get our margins. Then we can look at our returns, return on assets, return on equity. Again, we're using balance sheet data, so we use an average, and return on total capital. Some valuation ratios. This is looking at the quantity of asset or flow associated with an ownership claim. So we can look at some common valuation ratios: price to earnings, price to sales, price to cash flow, price to book, basic and diluted EPS, cash flow per share, EBITDA per share, dividends per share, payout ratios, and retention rates. Just a quick note here on ratios. For ratios that use only income statement items, use the values from the current income statement. For ratios using only balance sheet items, use the values from the current balance sheet. For ratios using both income statement and balance sheet items, we often see in the numerator as an income statement item, in the denominator a balance sheet item. You use the value from the current income statement and the average value for the balance sheet item. The reason is is that the balance sheet is giving you as at a certain date, for example, December 31st of the calendar year. But the income statement is covering the entire year from January 1st to December 31st. So to make it to make more sense of it, for the balance sheet, we're going to use an average, which is usually the beginning of the year plus the ending of the year divided by 2, and that matches up with the calendar year being used for the income statement. And that's the explanation why when we have a ratio that's using both income statement and balance sheet, for the balance sheet we're using an average value. Now we're going to start looking at the formulas for some of the ratios, and we're going to start with the activity ratios. Now, one of the things that I tell students that are studying, that don't have a strong background in accounting, is think of your debits and credits, okay? So if I sell something, I'm going to, on credit, I'm going to debit accounts receivable, and I'm going to credit sales, correct? And I sold something, it's got to come from somewhere, it came out of my inventory, and I had a cost to what I sold. So I'm going to debit my cost of goods sold, and I'm going to credit my inventory. So here's the journal entries. I also like the T accounts, okay? So then if we look at the inventory turnover, it's cost of goods sold divided by average inventory. Well, look at, that's my debits and credits. Cost of goods, debit cost of goods sold, credit inventory. That's an easy way to remember the formulas. Some students complain, so many formulas to remember, but if you've got a okay foundation in the basic accounting, it becomes a lot easier, okay? So that's my first tip. Cost of goods sold divided by inventory, because that's the journal entry. Debit cost of goods sold, credit inventory. Then if we take the turnover, the number that we get there, 365 divided by the turnover, it gives us the number of days, okay? And that's the way that I like to do it. I always like to calculate the turnover first, and then I calculate the number of days. Aha, look at my receivables turnover. It's revenue divided by average receivables. Wait a minute, I've got debit accounts receivable, credit sales. So again, the numerator and denominator are different there in terms of the placement. But again, I'm dealing with revenue and accounts receivable. So the receivable should be easy. Debit accounts receivable, credit sales. How do I get the turnover? Revenue over average receivables, okay? I take 365 over that turnover, and I've got my number of days, which we call sometimes DSO, days sales outstanding, days receivables. Sometimes you're going to see different terms. But again, go back to your basic accounting, your debits and credits, and then think about the ratios. It's relating something from the income statement to the balance sheet. Income statement to the balance sheet. Carrying on with our activity ratios now, we're looking at our payables turnover, which is our purchases divided by our average trade payables. Then the number of days payable equals 365 over the payables turnover. And so on the last slide in this slide, we looked at inventory turnover, accounts receivable turnover, and payables turnover, which are then converted into the number of days. 365 divided by the turnover is the number of days. So we've got days inventory, days sales outstanding, and number of days payable. If we combine the three ratios in terms of the number of days, we have what's called the cash conversion cycle, and we're going to see that later on. And so that's the days inventory. We buy inventory. It's going to sit in our inventory for a number of days. Then we sell it, and we have to wait to collect our cash in some cases. So we're going to add the days sales outstanding. But when we buy inventory, we don't have to pay for it right away. So we can subtract our days payable, okay? And that gives us our cash conversion cycle. And that's why these ratios are important to understand. So again, days of inventory plus days sales outstanding minus days payable. We're going to see that later on, okay? Working capital turnover, revenue divided by average working capital. And what is working capital? It's our current assets minus our current liabilities. So a practice question to check our knowledge. Again, when you see a practice question that has a lot of data, what I say as an exam tip is skip down and see what you're looking, what you need to look for first. Read the question part of it. So it says the company operates in an industry in which suppliers offer terms 210 net 30. The payables turnover for the average company is 8.5 times. Which of the following statement is most accurate? In 2011, the company on average took advantage of early payment discounts, paid its accounts within the payment terms provided, or paid its accounts more promptly than the average firm in the industry. So you can see from this, we're going to be looking at the payables turnover, okay? So by looking, this is an exam tip, by looking at the question first and reading it, Then don't spend time analyzing the data that they've given you. Oh, they've given me an income statement and a balance sheet, this number, that number. Skip down, read what you need to do, and then go back up, and you know that you're going to zoom in on the average accounts payable, and we need to calculate our purchases, but sometimes we use the cost of goods sold as a proxy for the purchases. The number is sometimes close enough, okay? Okay, for this one, the C is correct. C is the correct answer. They paid its accounts more promptly than the average firm in the industry. And why? Because we can see that the payables turnover is an average of 8.5 times, but the payables turnover for this company is 9.15 times, so they're paying more quickly. Now here, let's go through it again. The payables turnover is purchases divided by average payables. And here the purchases, cost of goods sold plus ending inventory minus beginning inventory, and then we had to do the average payables. But as I said, sometimes I wrote here in bold and green, if you just use the cost of goods sold divided by average payables, you're going to get an answer that's close enough that saves you a little bit of time with regards to all these calculations. So sometimes you can do that, take a shortcut. Sometimes it's a little bit risky. In this case, you could do it, okay? So then for the days payable, it's 365 divided by the turnover ratio. And so you can see if the turnover is higher, then the number of days is going to be less, correct? So that means it's turning over more quickly. So that's a nice little question. If you're getting into ratios for the first time, you need to read carefully what they're asking for. And then there's all kinds of data here that you didn't need. You know, it's the red herring data as usual. You have to be able to zoom in and pick the numbers that you want immediately, okay? So a nice little question to practice. So now we're moving on to the liquidity ratios. The first one, the current ratio, which is current assets divided by current liabilities. The quick ratio, sometimes you see it in the long form of cash plus short-term marketable securities plus receivables divided by the current liabilities. Sometimes you just see it as current assets, take out the inventory, current assets minus the inventory divided by the current liabilities, okay? And the cash ratio is just cash plus short-term marketable securities because they're sometimes considered to be a cash equivalent. You can sell them for cash so quickly. So it's just basically you're looking at your cash plus your short-term marketable securities divided by the current liabilities. You're taking out your inventory and your AR. Inventory and AR are current assets, but as we see in some cases, hard to sell the inventory. The inventory is not worth what it looks like on the balance sheet. If you look at the case of RIM, for example, and the inventory write-downs they had to take for the playbook, you'd understand why inventory sometimes at some time periods is not worth what it's showing. So to be more conservative, we take it out, to take inventory out of the current ratio, and we've got the quick ratio. Again, accounts receivable, sometimes it's hard to collect all accounts receivable. There could be stuff on the balance sheet that would be difficult to collect. So we then look at it again to be more conservative, look at the cash ratio. We take out the inventory and the AR, and we've got a real a better measure of liquidity, a more strict measure of liquidity, just cash plus the short-term marketable securities. How much do we have to pay our current liabilities? So nice little practice question. The current ratio for an industry is 3.2. Data for a company is listed below as at December 31st in thousands of pounds. Cash, 200. Accounts receivable, 350. Inventory, 1250. Accounts payable, 300. Taxes payable, 200. Installment loan payable due in 3 equal annual payments on June 30th, 600. Using the current ratio when compared with the industry, the firm is best described as being as liquid, less liquid, or more liquid. Okay, I like this question because there's just a little bit of a trick over here on the current liabilities that you need to be aware of. But again, the current ratio is going to be current assets divided by current liabilities. So we have to calculate our current assets, which we know cash plus accounts receivable plus inventory. We just add it up. We've got our current assets. That's pretty easy, 1250. Then our current liabilities, accounts payable is a current liability, taxes payable is a current liability, but we have this number here. It's an installment loan due in 3 equal annual. So what that means is 200 is a current liability. It's due this year, but 400 is due in the years after, so that's going to be long-term liability. So we had to include that as 200 to get our number right, okay? So now we've got our numerator as 800, and we have our denominator as 700, and we calculate that. We get a current ratio of 2.6, which is less than 3.2, and so the company is less liquid than the industry, so the correct answer is B. Okay, so that one, just a little adjustment that you had to make. Just be aware, installment loan payable due in 3 equal annual payments. The payment that is due this year is considered to be current. The payments that are due after are considered to be non-current, so we had to make a little adjustment there on our current liabilities. Nice little question. Another practice question to help consolidate our understanding. An analyst prepares common size balance sheets for 2 companies operating in the same industry. The analyst notes that both companies had the same proportion of current liabilities, long-term liabilities, and shareholders' equity, and the following ratios. Company 1, current ratio 2. Company 2, current ratio is also 2. Cash ratio for Company 1 and 2 are both 0.3. But the quick ratio, however, for Company 1 is 0.5 and Company 2 is 0.8. The most reasonable conclusion is that compared with Company 2, Company 1 had A, a higher percentage of assets associated with inventory, B, higher percentage of assets associated with accounts receivable, or C, a lower percentage of assets associated with marketable securities. Okay, I like this question because it makes you think a little bit. So we know the current ratio is current assets over current liabilities, and they're the same for the 2 companies. We know that the cash ratio is the current assets, and I said minus, take out the inventory and take out the accounts receivable, and divided by the current liabilities. And again, the cash ratio is the same for the 2 companies. But the quick ratio is going to be current assets minus the inventory, take out the inventory, divided by the current liabilities. So we can see Company 1 has a lower ratio than Company 2. So that means that the numerator is less than Company 2, okay? So what does that mean? It means that the inventories must be greater for Company 1 to make the numerator less. And that's the way I solve this. I don't try to think it all through my head. I'm going to write out the ratios, and then sometimes I can even plug in some test numbers if I feel I've got the time, just to be clear on it. But we can see, to make the numerator smaller for the quick ratio for Company 1, the inventory must have been greater. Okay, so that's the answer is A, that Company 1 had a higher percentage of assets associated with the inventory. Okay, so nice little question, because it's making you think through the ratio, the numerator and the denominator, which is larger, which is smaller, and then why. And if you write it out like this, you'll understand, oh, I have a smaller ratio. It means my numerator is smaller. That must mean my inventory was higher. I had a higher percentage of assets associated with the inventory. Okay, this is just a follow-up for the last question. As I said, sometimes you can quickly do a little math example that you make up, and you don't always have to try to think your way through the logic and formula. You just work it out. So for example, in this case, they gave you the current ratio for companies 1 and 2 was 2. So if I just chose the numbers, I like to use tens, hundreds, thousands, for example. So I did 100 in the numerator divided by 50. That's going to give you 2. Okay? So that's fine. And then I'm zooming in here on the quick ratio. I know that I'm taking out the inventory. So how am I going to get 0.5 and 0.8? Well, I know it's got to be 25 over 50 is going to give me 0.5, correct? So that would be 100 minus 75 gives me 25 over 50, which is my 0.5. Here on this case, for the 0.8, it would have to be 40 over 50 is going to give me 0.8. So it'd be 100 minus 60. So I can clearly see that for Company 1, I have a higher inventory value. I have 75 versus 60, okay? So as I said, you don't have to do this all the time, but sometimes, this is a nice little way of using some numbers that you made up to plug in the formula just to check, double check, confirm, because sometimes it's, if you're just looking at the words, it's harder to sometimes get the right answer. It's easy to make mistakes, okay? But just doing a little number example, you can see exactly what's going on. Company 1 had a higher percentage of assets associated with the inventory. Carrying on with some ratios with regards to liquidity, the defensive internal ratio, I haven't seen this in too many practice problems, by the way, but it's cash plus short-term marketable investments plus receivables, so we're not including inventory, divided by the daily cash expenditure, okay? Just one to memorize. And then again, we got here to the cash conversion cycle, which I mentioned earlier. It's just the days in inventory. I need to buy inventory. Then I'm going to sell it and wait to collect the money. But I can subtract my days payable because when I buy inventory, I don't pay for it right away. And that's the cash conversion cycle. So a quick little practice question to test us on that. An analyst gathers the following information about a company: cost of goods sold, 18.4 million, average inventory, 2.5 million, receivables turnover, 24 times, number of days payable equals 24 days. The company's cash conversion cycle in days is closest to A, 40 days, B, 59 days, or C, 65 days. Okay, a good little practice question. You have to do a couple of quick calculations, and speed is a skill. Skill gets rewarded. The more you practice, the quicker you get at these. So first of all, the cash conversion cycle, we know, is the days of inventory on hand plus the days sales outstanding minus the payables. So they're giving you some of the data here. You have to make a few quick calculations. So the inventory turnover, as I said, debit cost of goods sold, credit inventory. So we know our numerator and denominator, 18.4 divided by 2.5. So we get 7.36. Then 365 over the inventory turnover gives us our number of days. Great, we've got the first one, 49.6 days. Receivable turnover, they're giving us the times, they're not giving us the days. That's an easy one, 365 divided by 24, and we're going to get our number of days of 15.2. We're adding that. And finally, they gave us the days payable. Thank you very much. Minus 25, we get 39.8 days. And the cash conversion cycle is closest to A, which is 40. And again, you see it says closest to. That's the important thing. Sometimes you do your math, you check your calculator, you don't see the number, you think you've made a mistake in your calculation. No, they like to use closest to. So you have to be very careful with that sometimes. Again, that question should be considered to be CFA continuum of questions on the fairly easy side once you get up to speed on the ratios and practice a bit. Now I put these two questions back to back because in this one you have to make a lot more sub-calculations and more data is given to you, okay? So on the test, sometimes you get easier questions, sometimes you get harder questions testing on the same LOS, and that's the way it goes. So the following selected information is from a company's most recent financial statements. I won't read through all the numbers, but you've got 2008, 2009, sales, cost of goods sold, interest expense, and then you've got some balance sheet data, cash and marketable securities, some accounts receivable, some inventories, accounts payable, and notes payable. They're giving you 2 years of data because in some cases for balance sheet items, we need to use the average. So in this one, it's saying the 2009 cash conversion cycle in days is closest to A, 23 days, B, 26 days, or C, 28 days. Okay, we can see that the correct answer was A. It's closest to 23 days because it's 23.3 days. So you can see we had to do quite a bit of calculations. For the inventory, we had cost of goods sold, and we're using 2009, so that's the correct numerator. But then it's divided by average inventory. So here they were giving us the inventories, okay? So we had to do cost of goods sold divided by average inventory, and that gave us 7.39. 365 divided by 7.39 gives us our days on hand. For our receivables turnover, it's going to be sales. We have our 2009 sales divided by our average accounts receivable. Again, then 365 divided by the turnover gives us our days sales on hand. And the payables, again here, you see we used they're not giving us the purchases. So in that case, they're using cost of goods sold as a proxy for the purchases. As I said, you can do that in some cases. So it was the 1969 divided by the average payables, which we had down here. That's going to give us a payables turnover 5.57. 365 divided by the turnover always gives us our number of days, 65.5. So we know now our cash conversion, days on hand plus DSO minus days payable, bam, we've got 23.3, and it's closest to A. So again, 90 seconds might run over a little bit, 90 seconds on this one. A lot more calculations to do the same type of question. But again, in terms of the CFA continuum, very mechanical, not that difficult. I would say that's on the fairly easy side with regards to the accounting questions once you practice. So now we're moving on to some solvency ratios. So the debt to asset ratios, this is balance sheet to balance sheet, so we don't need to use any averages here. It's just the total debt to total assets. But what is total debt? It's the interest-bearing short-term and long-term debt. So different textbooks I've seen in the past use different calculations for the total debt. I've seen total liabilities use this total debt. But for the CFA, the total debt is the interest-bearing short-term and long-term debt. You want to be careful with that, okay? The next one is the debt to capital ratio. The numerator is total debt again, and the denominator is the total debt plus the total shareholders' equity. Carrying on with some solvency ratios, the debt to equity ratio is the total debt divided by total shareholders' equity, and the financial leverage ratio is average total assets divided by average total equity. This is an important one. It's going to come up later on when we look at the DuPont, which is an expanded formula for return on equity. Just leave it for now to say that the financial leverage ratio, average assets over average equity, is an important one. Okay, another practice question. So you can see, given the following information about a company, you can see they're giving quite a few line items here. So as I said, exam study skill tip, skip down and read what's required. What is the most appropriate conclusion an analyst can make about the solvency? Solvency has A, improved because the debt to equity ratio decreased, deteriorated because the debt to equity ratio increased, or C, improved because the fixed charge coverage ratio has increased. So now you know two of them are asking for the debt to equity. So we're going to try to zoom in when we're looking at the data then. What is the debt to equity? Okay, this is a nice little question. We had to do the debt to equity, so we had to calculate the total debt, which is the short-term borrowings plus the current portion of long-term interest-bearing debt plus the long-term interest-bearing debt. That's our debt. And our equity we had here was given to us. So a pretty easy calculation. We can see that our debt to equity went from 2010, 74%, down to 70%. So the ratio decreased. The company has less financial risk. It's more solvent. So A was correct. The debt to equity has decreased, thereby improving solvency. The fixed charge ratio remained the same. Okay, the fixed charge ratio, we haven't seen that ratio yet. Sometimes I throw in a practice question before we see it just to we can learn something from looking at the solution to this. The fixed charge coverage ratio is just the EBIT plus the lease payments divided by interest payments plus the lease payments, okay? But we can see for 2011 and 2010, there was no change to the number. So it was the debt to equity calculation that was driving the solution. A was correct. So carrying on with the solvency ratios, interest coverage is an easy one. It's EBIT divided by the interest payments. And we know if we look at the income statement, sales minus cost of goods sold gives us our gross profit, minus SG&A, okay, gives us our EBIT, minus our interest gives us our earnings before tax. So the interest coverage ratio is just the two lines typically in the income statement, the EBIT divided by the interest payments. So again, for people that are just picking up accounting for the first time, that's an easy one to remember. Now that last practice question, I gave the fixed charge coverage question before we looked at this slide. I like to do that sometimes because it's so easy to look at a ratio like this, the fixed charge coverage, and kind of go over it and not really memorize it, and you can see it comes up in a practice question. So sometimes I like to put the question before we see the formula, and sometimes I put the question right after you see the formula. And in this case, it kind of shocks you. Oh yeah, the fixed charge coverage, that's the EBIT plus the lease payments divided by the interest payments plus the lease payments. That's an important one to remember. So many of these ratios are so easy to understand, to calculate, to memorize. It's when they throw at you something like this, it's not used as much, the fixed charge coverage, okay? EBIT plus the lease payments divided by interest payments plus the lease payments. Very important one to remember, as you could see from that previous practice question that we just did. Now we're moving on to the profitability ratios. The gross profit margin is gross profit divided by revenue. Operating profit margin, operating income divided by revenue. When we're looking at margins, we're always dividing by revenue, okay? So the operating income, gross profit minus operating costs, an approximation is EBIT, but an important thing here to understand, EBIT contains non-operating items, dividends received, and gains and losses on investment securities. Two more ratios on profitability very quickly. Pre-tax margin, it's just the earnings before tax divided by revenue. Net profit margin is our net income divided by revenue. Now we're looking at some of our return ratios with regards to profitability. Return on assets, net income from the income statement divided by average total assets. Again, that's on the balance sheet, so we're using the average, okay? There's showing here an alternative ROA, which is net income plus the interest expense times 1 minus the tax rate divided by average total assets. Anyhow, that's kind of an FYI. I haven't seen that tested much in terms of practice questions. Operating return on assets. Anytime you see operating, we're just talking about the operating income, again, divided by the average total assets. Continuing with our profitability ratios, return on capital. Be careful here. We're not looking at net income in the numerator. We've got EBIT, okay? So the return on total capital, EBIT, divided by short plus long-term debt plus the equity. Total capital is our debt plus our equity, basically. So that's why they're saying short plus the long-term debt. Return on equity, that's an easy one. That's net income divided by the average total equity. We're going to learn a lot more about that when we look at the DuPont. It comes up in the equity section a lot. So it's an important one. And the return on common equity, again, it's net income minus the preferred dividend, because that's the earnings available to the common shareholders divided by the average common equity, okay? So those are two very important, but we're going to see lots more of that throughout the CFA program. Now we're moving into the valuation ratios. We see a lot more of this in the equity section in CFA, and especially in CFA level 2 as well. So we have PE, that's the price per share divided by the earnings per share. P to CF, price per share to cash flow. P to S, price per share to sales per share. See, that's per share. That's be careful, cash flow per share. And everything is on a per share basis. And P to BV, price to book value, that's the book value of the share, okay? A practice question here to help us. When analyzing a company that prepares its financial statements according to US GAAP, calculating the price tangible book value ratio instead of the price to book value ratio is most appropriate if A, it grows primarily through acquisitions, B, develops its patents and processes internally, or C, invests a substantial amount in new capital assets. I like that question because it shows you that you need to go through the text. Sometimes in review notes, not everything is covered. So where did this tangible book value come from instead of the price to book value, okay? Well, it is in the text, and the correct answer is A. It's most appropriate if the company is growing through acquisitions. Why? A company that grows primarily through acquisition will have more goodwill and other intangible assets on its balance sheet than a company with fewer acquisitions or that has grown internally. To provide for comparisons with companies that do not follow such a growth strategy, an analyst would remove all intangibles and focus on the tangible book value. So a good question. Again, we're in accounting. No math required in that, but a little bit of understanding some theory and so the differences between a price tangible book value and the price to book value. So just to hit home on that point, here's a practice question. To compute tangible book value, an analyst would A, add goodwill to stockholders' equity, B, add all intangible assets to stockholders' equity, or C, subtract all intangible assets from stockholders' equity. So C is correct. Tangible book value removes all intangible assets, including goodwill, from the balance sheet. And as I said, this is a bit buried in the chapter. I'm one who's convinced that you need to pay close attention to the CFA curriculum, especially as we get into level 2. Carrying on with some valuation formulas. and ratios. The basic earnings per share is net income minus the preferred dividends divided by the weighted average number of ordinary shares. And we see that in other LOSs through the CFA, so this should be fairly easy and familiar. The diluted EPS is the income adjusted for dilutive securities divided by the weighted average number of shares adjusted for dilution. And there's a lot of LOS, a lot of calculations that we need to do. Nothing new there. Cash flow per share, we're always looking, when it's cash flow, we're always looking at the operating cash flows. So the numerator is always the CFO. So it's just the CFO divided by the weighted average number of shares. That's how we get our cash flow per share. Carrying on with the valuation, EBITDA per share, numerator is EBITDA, and the denominator average number of ordinary shares. Okay. Dividends per share, the common dividend divided by the weighted average number of common shares. So carrying on with the valuation ratios, the dividend payout ratio is the common dividend divided by the net income minus the preferred dividend. Don't forget to subtract out the preferred dividend because that's the net income attributable to the common shares. And then the retention rate, we give that a symbol of B. That's just 1 minus the payout ratio, correct? That's going to give us equals our retention rate. And that's important. We're going to see later on when we get into our equity valuation that G equals the retention rate times ROE, and we need our growth. We need to calculate our growth because when we're using the dividend discount model, P naught is going to equal D1 over K minus G, and so we need to calculate that G by using the retention rate times the ROE. They don't give us the retention rate. We have to sometimes calculate the dividend payout ratio. So again, once we get into the equities, we're going to be going through these formulas in great detail. That might be a little bit too early for you because we're just covering some of the accounting. We haven't got to the equities yet, but this is just a little bit of a preview of why these formulas come into play, are so important in CFA Level 1. So the last slide, I gave a little preview to this. The sustainable growth rate equals the retention rate times the ROE, okay? And the retention rate is 1 minus the dividend payout ratio, so that's our G. And often we need G, as I said, for our dividend discount model. And later on, we're going to see the ROE. We can break that down. That's net income over equity, but we're going to use the DuPont to further decompose that, deconstruct that to net income over sales, which is our profitability, times sales over assets, which is an asset turnover ratio, times assets over equity, and we saw that was our leverage, correct? We saw that ratio already, and if we scratch out the numerators and denominators here, we're back to our net income over equity, okay? So we're going to be going through a lot of this later on in the equity section, but this is why we in this portion, we're getting the foundation in terms of the ratios, and that's where we're headed. So we're going to finish this LOS with 2 practice questions. This has been a long one. It's probably one of the longest videos that we have, but it's accounting and it's strong, it's a basic foundation for a lot of CFA Level 1 and Level 2, so it's an important section. So this question, an analyst gathered the following data for 2 companies in the same industry. We've got the days sales outstanding, the days of inventory, the days payable. We can see in this case, company A, days sales outstanding is less, days of inventory on hand is less, but the days payable is more, okay? Then we've got some current assets, current liabilities, total liabilities, shareholders' equity, and the question is asking us, which of the following is most appropriate conclusion the analyst can make compared to company B? Company A is more liquid, has more financial risk, or C, has a longer time between cash outlay and cash collection? I like this question. I would say on the CFA continuum of questions, this is now starting to get a little bit harder because you have to make 3 sub-calculations for 2 companies and come up with some types of conclusions. So now we're really starting to consolidate quite a bit of information into one question. So if we look at, let's start with the easier one though, has a longer time between cash outlay and cash collection. That's the cash conversion cycle, which is, and they're giving us the data here very, very easily, very quickly. So you do that one first. you can see the cash conversion cycle, days in sales outstanding plus the inventory minus the payables. For company A, it's 18. For company B, it's 27. So it's less than. So you know C is wrong. A lot of times if we take out the answers that are most definitely wrong, what's left over is right. Sometimes we save a calculation, okay? So the next thing is more liquid. That's an easy one. That's current assets over current liabilities. And you can see company A is greater than company B in terms of the current ratio. So we're in pretty good shape. At that point, I may answer A right away. But if I want to check B just to be on the safe side, the financial leverage, assets over equity, we can see it is it has less financial leverage because the assets over equity is a lower number. Okay, so B was wrong. It is definitely more liquid. It has a better current ratio. So a nice question because you're having to do a liquidity ratio, a cash conversion, and a financial leverage. This often happens that it's kind of like 3 questions within one, quite a series of calculations to come up with the correct answer. And down to a last practice question. Which of the following transactions will most likely result in a decrease in a company's current ratio? A, recording of warranty expense. B, recording of revenue before cash is received. Or C, payment of a property insurance policy for the following year. So we're looking most likely a decrease in the current ratio. Okay, I like this question because it's very typical of something you might see on the CFA exam where they're asking you what is most likely or least likely going to happen to a certain ratio. So you have to understand not only the transaction, your debits and credits, but also what's happening to the numerator denominator and come up with the correct answer. So that's why I've ended with this question for this LOS. It's very typical of what you might see. So the correct answer was A, the recording of a warranty expense will create a warranty liability, and the resulting increase in current liabilities will decrease the current ratio. So current assets divided by current liabilities, you increase the denominator, you're going to decrease the ratio. And that's what you need to do. Write out the ratio and do your little arrows on what's happening to the numerator denominator, and then figure out what's happening to the ratio. Is it going up or down? So as I said down here, do your T accounts quickly. For A, it's debit warranty expense, credit warranty liability. My liability went up. For B, it's a recording of revenue before cash is received. It's debit accounts receivable, credit sales. Debit accounts receivable, my asset went up. So in that case, my current asset went up. So my ratio is going to increase, correct? My numerator has gone up. And for the C, payment of a property insurance policy for the following year, that's an easy one. That's going to be debit the prepaid insurance, credit cash. That's no change to the A. We go back to the A equals L plus E, correct? There's no change to an A. There's not going to be any change to my numerator, so there's no change, okay? So that's a nice one, and that's the last slide for this LOS. Thank you.